Good morning, folks. Hope everyone's having a great trading week so far, this holiday shortened trading week that we're going through, which usually these types of weeks have a decent chance of sort of floating upwards, which we're doing so far. Just getting everything going on these streams so we can move forward for the event we have planned for you all today. So, folks, it is once again Taco Tuesday. It is time for this week's episode of Back to the Futures with me, Markets and Mayhem. And we've had some mayhem in these markets over the month of November, haven't we? It's been pretty interesting. Part of it has to do with the AI narrative coming into greater scrutiny by investors and traders, questioning the underlying presumptions about what's happening, whether all this money is really going to be spent, the growth impacts. But we also had a spectacular run from the April lows, so it was pretty much inevitable we're going to have some kind of pullback. Market was looking for any excuse for that to happen. And so to some degree it has. Whether or not we've put in a durable low, that's a whole other matter altogether. But we'll explore a lot of what we're looking for in terms of some of the levels we're watching. I've got the weekly pivots to share with you all. Before we dive in, though, of course, we've always got to talk about risk. I put the disclaimer on screen, but I also just want to take a moment to say don't risk more than you're willing to lose. That is so much more important than people think. There's this unrealistic expectation often that, hey, all you need to do is just buy some options or buy some stock and you'll make so much money. You'll be able to, quit your day job. And gosh, I wish I could save people from that unrealistic expectation, only because it really is that lack of patience and that sort of thinking that, oh, it's very easy and all you do is put money in and you get a lot of money out. A lot of the time, that's what hurts people because they get this idea that they don't need to put in the effort, the work. But I'll tell you, in my own experience, the work has been what defines people that succeed from people that don't. That has been such a huge part of a trader's journey. So I highly, 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 highly recommend putting in the work. And we'll talk about what I mean. First of all, are you keeping a trading journal? If not, you are not doing yourself justice. Here's why. Trading is a business. You are buying and selling inventory. You're hoping to capture a positive spread repeatedly. That is the essence of what we're doing. In order to improve our consistency in capturing that spread, we need to learn what works and what doesn't. So if you're not keeping a trading journal, how can you expect to be able to get better at trading if you're not holding yourself accountable? identifying your weaknesses, addressing them, focusing on your strengths. How are you going to learn what works and what doesn't and how you can get better? This is a centerpiece. The other centerpiece is managing risk. Like I said, don't risk more than you're willing to lose. You know, a great way to help with that process of sizing your position? Knowing how volatile it is so you can plan your stop out. Things that are more volatile, we size down. Things that are less volatile, we size up. That alone can save you so much pain. So a little bit about me. I started trading 20 years ago. I know I'm aging myself, but I also have a lot of experience and wisdom to share. And that's one of the reasons why I do what I do. I was fortunate enough to have some great mentorship early on in my journey. Met fund managers, met floor traders, met desk traders at institutions, met folks in the world of hedge funds. And it was interesting to see how different all these different people had. Their approaches were all so varied. You had your fundamental value-driven asset managers. You had your momentum growth-driven managers. You had your commodity managers that were largely trading off momentum. You had folks that were just day trading, folks that were swing trading, folks that were investing over really long time horizons. And what I learned early on was we all have different ways to approach the market. No one's necessarily wrong as long as you're able to consistently make money. That was a really important part of my journey, which led me to appreciate from my own experience that I could mix in some degree of day trading, swing trading, and investing to find my path. Because not everything that you want to have materialize is going to happen in, a specific time frame. So, for example, you might be looking at the S&P bullishly and saying, how can I day trade that? Well, certainly there might be some uptrend days to capitalize on, but maybe there's a longer term trend to capitalize on as a swing trader and an investor. And indeed there is. So why wouldn't we want to express that view over multiple time frames to be able to benefit from it? This is also something that I like to talk about with regards to trading. Success in trading has a lot to do with rolling your profits into longer time horizons. So when my day trading or swing trading accounts, and I keep separate accounts for all of these things, when they get over certain thresholds, I roll those profits into long-term investments. No questions asked. Why? Because that is a really, really helpful way to diversify, to grow your capital over time, and to not have too much risk concentrated in just your trades. And those investments don't necessarily have to just be stocks. Those investments could be businesses. They could be real estate. They could be all kinds of different possibilities. So that's another thing to really take into consideration. What is your goal? What are you trying to accomplish with trading? Are you trying to create a stream of income? Are you trying to grow your wealth? Are you trying to, learn a new skill? What are your goals, and are they realistic for the time frame that you're looking at? If you're trying to become a millionaire by the end of the week and you only got 10 grand in your account, I hate to break it to you, but it's very unlikely that happens. And if it does, and you're not using some sort of process and you just think, this is how it works, you've just gotten lucky. You'll probably lose all of those gains. That's another thing, is having a process, defining risk and reward, understanding why you're getting into trades and why you're leaving them, allows us to understand what works and doesn't work so that we can build that consistency. So important. That's why I start every week stream with this sort of trading sermon, if you will. I'm preaching this stuff because this is the stuff that keeps me grounded, that puts guardrails on my approach to trading, which has allowed me to continue trading markets for 20 years. I'm a statistical outlier. There's not many folks that trade for that long. Most people burn out or blow up in their first year. So the reason that I try to draw from some of the wisdom I have and what's kept me in the game for 2 decades is because I want you to be able to enjoy learning from my mistakes, leaning into the things that I found that have worked so you can save yourself that pain. That's a really important part. Learning from other people. And I know, it doesn't always suit the ego and all that sort of stuff, but let's be real. The ego has no place in trading whatsoever. That is the reality. I think we all kind of know that in the back of our head. It's nice to call a top or a bottom for stroking the ego, but you can't consistently do that in trading. What trading is about is capturing the momentum in that move. You don't need to nail the low or the high. You need to capture the bulk of the move. That's where the money comes from. That's where the repeatability comes from. And that's why it's important to have some kind of systematic approach. These approaches can be made in a number of different ways. I encourage people to consider backtesting to learn more about the personality of their instruments and backtesting with specific regimes as a background. So, what do I mean by specific regimes? Well, if you're in a bull market, you're going to probably want to test your asset class during other bull markets rather than the entire scope of time. So you can have some more specificity about the regime you're in and how you may trade it. Similar with bear markets and also periods of consolidation, periods of uptrends, periods of downtrends. The more granular specificity you can add to your backtesting data set, the better off you're likely to be in your overall results over time. It also means don't look back too far. Once you start going back beyond 5, 10 years, because markets have evolved so much and what's driving them, particularly these days options, has become such a more formidable force, going back too far can lead to errant data. But having a data driven approach is so much better than not. That's really the core here. So, for my own journey, I started off as a discretionary All right. I think might have been an audio issue for some of the folks out there on YouTube and otherwise, so I apologize for that. But we are getting ready for this market open here. 7 minutes away. Should be a pretty interesting day. Holiday trading week means you're going to expect less liquidity, potentially exaggerated reactions, and that's something that we certainly saw yesterday. It could play a role in today's trading as well. So just keep that in mind. So these are the weekly pivots: bullish above, bearish below. I'm going to share these on Twitter for you folks as well. So you'll find that on my feed. I've just posted that out there. So these pivots are built from a framework of analyzing volume, price action, and a few other variables. And they're really for a swing time frame, but they're pretty powerful intraday as well. These levels, you can see, they can be strong areas of support and resistance. And if you remember that last chart I just showed of the pivot levels, they are derived from that algorithmic analysis that's shared with our Discord members on Traderade throughout whenever markets are open for the intraday pivots and for the major pivots. So, I talked about saving time, mental capital. One of the biggest parts about saving time is automating your analysis where you can, where it keeps the quality the same or ideally makes it better. That's a really important part of the process. That's one of the reasons I still think it's worthwhile understanding something about coding. You don't have to be a programming extraordinaire, but knowing enough to be able to build some of your tools. You can lean into some of the AI stuff to help, but at least have some bearing as to how that stuff works. That can help, because if you're automating parts of your process that ordinarily would take a lot of time, that's what I call winning. And that's what these pivots are all about. It's all about using some degree of automation to be able to take time back that we would ordinarily be staring at charts, looking at where these levels on the volume profile are, where they are in price action, etc. Anywhere you can automate that is a win, because again, it helps to reduce burnout. And of course, if you don't want to spend the time automating it yourself, we've got those charts and a lot of other cool trading tools available at Traderade. And the folks at Bookmap would like you to know they've got some pro trader webinars coming up from a variety of different experts. And also, we've got some great deals to share with you all. Exclusive deals. You can get up to 40% off of Traderade plans using the code BlackFriday40 at checkout. This is a very short-term offer. Up to 20 coupons are available. Several have already been used. Once that expires, or once we get to the end of this week, basically Sunday night, this offer is gone. So this is one of our most generous offers that we've had all year. 40% off Traderade plans. Use the code BlackFriday40 at checkout. You can visit our website for details at Traderade.com. And also get up to 40% off of Bookmap. Visit Traderade.com/Bookmap and scroll down to the special offer. So 2 really awesome deals for you all. And more to come. Bookmap's got some really cool stuff coming up for Black Friday as well. So stay tuned. We're going to now move away from the presentation and go right into Bookmap itself. And folks out there, if you have any questions for me, let me know. Good morning, Low-Key. Good to see you, buddy. Let's have a look here. We did get some data today. We got retail sales. They came in a little lower than expected. We got PPI. Year over year came in higher than expected. Core came in lower than expected, mostly in line. Core month over month came in about half of what the expectation was, 1/10 of 1% versus 2/10 of 1% in the forecast. And core retail sales very much in line at 1/3% versus a forecast of 1/3%. 10 a.m. we've got consumer confidence coming in from the conference board with a forecast of 93.3, prior read of 94.6, and pending home sales as well as business inventory. So 10 a.m. is going to be an event volatility catalyst in these markets that we're going to want to pay attention to. That's pretty much the biggest catalyst that we know of today. Obviously, there can be things we don't know that can occur as well. All right, let's see. So let's zoom out a little bit here. Take a look at the overnight session for the S&P 500 futures. Overall, relatively uneventful, as one would expect. Pretty much consolidating all night, which to me is interesting. I look at consolidation as a coiled spring, so you could have some energy built up from all that consolidation that gets expressed during regular trading hours, which we're now in. Markets just opened. Got a market on open imbalance of plus 300 million on the S&P, 27 million on the NASDAQ, 78 million on the Dow 30, and 5 million on the Mag 7. And let's just take a quick look at what the SPX options visualizer is telling us. We are right near the calculated gamma flip level. So right now we're essentially in neutral gamma. And what that tells you is that that means the influence that dealers have on price action as they're making markets is reduced. In positive gamma, you have selling of rips and buying of dips. In negative gamma, you have buying of rips and selling of dips. And in neutral gamma, that effect is largely neutralized. And that's essentially where we are. We're starting to build into positive gamma, but we're essentially in this sort of neutral zone right now. And I am seeing a kind of big delay from Rhythmic right here, so I'm just going to restart really quickly, see if that clears that up. So give me 1 second. And folks, on an aside, there is absolutely no shame in taking this week off. You don't have to be glued to the market. You can always go out, touch grass, and I certainly would encourage hanging out, spending time with friends and family. right, we've got Bookmap back on screen here, just backfilling some of the data that's already come through. You can also see yesterday's flow. That hot call, that most active strike, got a lot of attention. We did tag it during the trading day. I talked about that live on my Twitter stream, that we'd seen a lot of positive flow coming in. We'll talk about the flow this morning when it hits the tape as well. And we do have a nice strong open so far, some pretty good volume. Getting right back up to the hot call implied area. That may provide us some resistance. Certainly during the overnight session, it did just that. We'll just take a look at a different chart here real quick. And we can see that here on this chart from Motive Wave. This is just another way of visualizing the same data with 5-minute candlesticks. That hot call repeatedly in the pre-market had been resistance. So we know this will be sort of our intraday pivot. If we can push above 67.27, that hot call from yesterday, build some acceptance above, I'm going to look at this with a much more bullish mindset. I'm already inclined to lean a little more bullish just as a holiday shortened trading week. Most of the time you're going to float higher. And we can see we're testing that level here. And Bookmap's giving us a sense that we've got a decent amount of conviction with the size of these delta bubbles. A little bit of passive selling overhead, 300 iceberg sale. Not enough to warrant too much concern, especially since buyers so far seem undeterred. Icebergs in and of themselves don't mean a lot. It's when you see price react to them that it becomes much more interesting. And I think that's true of a lot of indicators. You're looking for the reaction function of the market. Someone comes in and dumps a 3,000 iceberg up over the S&P, and it just keeps climbing, then that tells you, boy, buyers are undeterred. They've got plenty of demand. On the other side, if you see that 3,000 iceberg and price turns around and heads the other way, that's giving you a sense that, that discouraged them, that they may not have the demand to get through that implied supply. So applying auction theory to the market is really, really, really important. And overall, this is an order book that leans on the bid. You got 15,000 on bid versus 12,000 on offer, a delta of 3,000. So that's also a good sign for buyers that demand, at least so far with this balance, is there. So we discussed a little bit earlier, watching that hot call as an area of resistance, that yesterday's most active strike so far playing out as a resistance level for buyers to overtake. Sellers aren't showing much conviction here. It's from really just buyers stepping aside after we saw that iceberg sale and after we got into yesterday's area of most active SPX options demand converted to ES levels by our SPX options visualizer. Which, by the way, you could find out more about that by visiting Traderade.com/SPX. I think this thing is going to try to make a big push here up. You see some offers starting to stack overhead as well, just giving you a sense that there's interest in higher prices. Buyers remain determined. Sellers haven't made too much of a dent in this price action so far. So we're building acceptance above the point of control here. Also above key 1 plus, which is a large area of call implied resistance based on the visualizer's algorithmic analysis of the options chain. So we'll see. Let's see what the market gives us here. If we push below the point of control, I'll have to reevaluate that if we build acceptance below it. But for now, the markets have a bit of a bullish look. I do like to look at the 20-minute opening range pretty closely as well. I like to do that both for seeing whether or not there's a potential trend day or consolidation day. But I also like to watch those levels throughout the day because you'll be surprised. You'll go back and react to the opening range, high, low, mid, repeatedly on some days, especially consolidation days or double break days where you break out on one side of the range, then you break down the other side of the range, which, by the way, Tuesdays have about a 60% chance of doing that. That double break Tuesday is what I like to call it. So we are testing below the point of control here. Starting to actually see sellers pick up a little bit on their aggression. So far we can say that hot call level overhead providing resistance. For me, in the way that I like to trade this, I would like to see us define a little bit larger of an opening range. This is not bad though so far. This is pretty solid. This is like a 18 handle opening range. So that suggests we'll see some dynamism in the tape today. And then from there, once we have that range defined, I'd like to see either side of it pierced with some acceptance built. That is to say, if we see the upside pierced, and we can hang up above 67.30, assuming that's the top of the range after 9.50. That would be when the 20-minute range caps off. Then that would give me a sense that we're making that upside break. There might be a continuation off that. That could be tradable. And we could also have a two-sided day where you get that double break. Again, Tuesdays, 6 out of 10 times, tend to be double breaks on that opening range. So sometimes you get the opportunity to trade both directions. Also suggest Tuesdays are a day where you should be a bit more nimble, especially on a holiday trading week. We're now getting down to the lower end of the opening range. I said if we did push below that point of control, I'd reevaluate a little bit here. So still looking for really that first flow to come out from the SPX options trades and for that 20-minute opening range to be defined. But for now, it looks like we're about to make a lower low as seller aggression picks up. And I don't think the story with this tape is anywhere near over. I think this will be a two-sided dynamic trading day so far. It does have that feel to it. We are making a bigger opening range here too. I am getting that wish that I was looking for. Now about 24 handles. So looking like it could be a much more dynamic trading day. Getting into some of that liquidity below, a lot on bid, and some of those bids are starting to thicken up a bit as we head lower. We should start seeing the flow coming through from CBOE and other options venues pretty soon for today's trading. I suspect it's going to be put heavy. I think some of this is probably hedging. We also remember, we talked about this earlier, we've got some calendar events coming in. CB Consumer Confidence, pending home sales, and business inventories at 10 a.m. Eastern. And this is about a 28 handle range so far. This is pretty juicy. This could set up to be a fun day. And I just want to take a minute to highlight that resistance area where the hot call was. Obviously, it's no longer there because we're factoring for today's options flow. But you can see how that proved to be resistance. So that was another area we talked about focusing on. That would be my bullish above pivot. We never got it. We never got it. We're just going lower and lower. So even though I had a feeling that maybe we could have a bullish day, I grounded that, as we talked about during the stream, by saying we still need to make a push above this level. We still need to find acceptance above the opening range, and we still need to see the flow. So you can see why having some degree of restraint, by letting the data drive your trading and looking for confidence through confluence, can get you out of the way of making a mistake. Because if I just leaned into that feeling, that discretionary approach, I would have had my face ripped off on this move. Obviously, I would have been stopped out by now, but this wouldn't have been a great way to start the day. Instead, I have a process. I don't trade the open, for one. It tends to be a gamble. And two, I have things I've got to look for to qualify a trade. We're still in that 20-minute opening range. And by the way, this is an enormous opening range. So this really does suggest we're going to have a very dynamic, possibly volatile trading day ahead of us. Now we're looking at about a 34 handle opening range. And I still have a feeling this could end up being a double break Tuesday. So this could be an interesting day. A lot of folks are out. A lot of the folks that run trading desks are out. A lot of their bosses are out. You know, people have already started their Thanksgiving travel, and that's another thing that will make this market more interesting. There's a lot more bots trading it than people at this point. I mean, that's all. Obviously, that's the case almost every day, but like that proportionality has shifted way more towards the bots. Let's take a look at Bitcoin real quick. Yeah, it's following the same script. After the U.S. market open, just rolling over. NASDAQ, same look as well. I mean, obviously the U.S. stock market's going to kind of move in sequence, but the amount of weakness in tech right now, my goodness. And NVIDIA is absolutely getting murdered here. I'm going to share a chart with you all. Here, let's put this on screen. That is the market map. NVIDIA down 6.42%. That is massive for the largest company on earth to be getting such an aggressive markdown. You've got AMD down 9%. You've got Oracle down 7%. CrowdStrike down 2.5%. Tesla, Microsoft down near 2%. Over 2% in the case of Tesla. And a bit of a rotation into healthcare. into consumer defensives, into utilities and other areas of the market. So that is not really what you want to see if you're bullish of this market. This market is just in sort of a free fall mode right now. It's pretty orderly selling. There's not a lot of fear. It's just distribution. And it isn't really a put heavy tape. This is actually, so far, it looks like it's actually selling pressure. It's not driven by options as much as people getting out of some of those positions and rotating those positions into safer parts of the market. This has been a theme for much of November. So it seems like the risk off rotation is continuing today. 10 minutes away from data here. We formed our 20-minute opening range, by the way, and it is a whopper. About 50 handles. Seeing a little bit of bid off the second most active put strike here. This also takes us down to a pivot level we were watching just down here around 66.81. That has some confluence with that warm put level as well. So that's acting as support. This is from our ES dynamic pivot stream on the Traderade Discord. Calculates these levels. We could also see there's major resistance overhead at 6743.75. And during the pre-market, we did see some signs on the subchart of momentum exhaustion as well. So there were some signs. It wouldn't be enough to say, hey, I'm just going to fade the open. There wasn't anything that really stood out to me. Maybe others caught that in advance and knew that this was going to happen. And if they did, kudos. To me, I just came in with a neutral, open mind about what could happen because my process has informed me over the years that that's the best way to look at these things. So I wasn't just going to hold my nose and short this thing at the open, but certainly that would have been the play overall. You would have had a bit of a head fake here and then just rolling over. I will, however, remind folks, this is a market that loves to put in V bottoms, and it kind of looks like it's trying to do that here. We'll see. We've got data coming up in just about 8 minutes. And we have big call flow starting to come through. Let's see. Yeah, let me just take a look at the overall structure. Yeah, hot calls being chased with 3,000 of volume, hot put 2,000. So it's definitely looking like we're going to want to try to turn up if that flow continues. Keep an eye on it as we approach the events. Another thing to be careful of is trading up ahead of and during events. Things like CPI, PPI, but even consumer confidence can shake things up if it's a reading that is a deviation away from expectations. You can have a price reaction hit the tape that could stop you out of a trade even if you're on the right side of it because of how much market makers pull back. And you'll see it in the order book. You'll see liquidity lighten up ahead of the event. That's one thing that'll increase slippage and basically add to the risk that you have to manage if you're trading through one of those events. Not only parsing the data in real time and as to whether or not it's bullish or bearish, but then dealing with the actual market reaction function and the fact that the range in which that function expresses itself could be far larger than it would during a normal tape because so much of that liquidity has pulled back away from where price is. So one reason you just want to be careful trading events. Doesn't mean you can't trade around them. Just trading during them often is a little bit more risky. Like if anything in your odds, when you're managing your risk to reward, look like 50-50, or even anything less than 2-to-1 risk, reward to risk, it's usually a gamble that's not worth it. That's the way I like to look at it, at least. I'd really like my stop out to be a much smaller level of risk that I hope not to realize than what the potential reward is. Otherwise, you may as well just toss a coin because you're not really putting probabilities on your side. So we are getting that V bottom feel so far. Whatever the heck that all was. Let's take a look back at the heat map here. NVIDIA's cut its losses by about 1%. We see some of these other stocks coming back off their lows. But that was, whatever that was there, probably some kind of sell program without the liquidity to absorb it on the other side. That was kind of nasty. It's also why you don't want to get too cute trading the open. How many people that faded the open would have known exactly where to get out if they didn't have a system and they're just like, hold my nose, fade the open. At this point, you're almost back to break even. But whatever the case may be, the one thing that I want to imprint is that large of an opening range leaves us for the potential of this being a pretty fun trading day. The caveat, of course, being that it's a holiday week. So that could make things a little more weird. But the fact that we're outside of OPEX, so we're unclenched by a lot of gamma exposure, adds to the dynamism of this market, as does this opening range, and also the implied range of strikes at play here. The most active strikes give us a little bit of juice. I still think there's a chance this thing could come up and tag the hot call. As odd as that sounds after an open that nasty, if flow continues to look like this, that is a realistic shot. On the other side of it, we can't ignore the fact that the hot put has some confluence with a 1,000 bid just down here around 66.40. So we see there's a lot of interest in that lower price, but as long as the flow favors the upside, we've got a pretty good chance. For me, I want to see to get the bulls in a really solid chance of taking out that hot call level. We're already testing VWAP. That's the white horizontal line here. I'd love to see us push above the point of control in this gamma flip level. That would really put the bulls in charge. It would also take them away from the danger zone. You can see under the session volume profile, you've got some big buy deltas popping out here. That move lower put a lot of those bulls off sides. We did have a stop run during it. What would give them more comfort to lean back in is to get above some of those aggressive buy deltas from earlier. That's where things would accelerate. So we have our confluence zone. VWAP, gamma flip, point of control, aggressive buy delta. All four tell us this zone is really important for the buyers to push above. Speaking of buyers, some sellers were just forced to buy back in with that 296 stop run. Was that not a crazy move? Let's just put it on a 5-minute chart real quick just to illustrate how crazy that was. What? If you blinked, you would have missed it. We're basically back to where we opened this market now. So much can happen in such a short period of time, especially on a holiday week. This is exactly why you've got to be careful trading a thin tape. The moves are exaggerated. Coming back up to gamma flip here. and to one of the largest buy-side deltas, that 51.91. It's around 67.14, 67.15. There's a change of character here too. Sellers aren't really leaning, and when they've tried, it's not having any effect. Options flow also strongly points to a bullish outcome. Look at the flow. Hot call 7K, targeting key 3 plus. Testing the point of control now above VWAP and Gamma Flip, pushing more and more of those aggressive buy deltas, getting above them. So overall, this is starting to look a lot better. And you can see, look at the order book liquidity lightening up ahead of the events. Coming in 30 seconds, we've got pending home sales, consumer confidence, and business inventories. For consumer confidence, the forecast is 93.3. A big enough outlier could move this market. So be careful trading this. Let's see what the data says. But overall, we've had a great rebound off that low. And this is, again, looking more and more like a double break Tuesday. We talked about that too earlier in the stream, that you can break one way and then right back the other way, and Tuesdays have a 60% shot of doing that over the last 5 years. Consumer confidence coming in bad, 88.7 versus a forecast of 93.3. Again, consumer confidence coming in rather poor, 88.7 versus a forecast of 93.3. Given this is a market that really wants the Fed to intervene in December, this could actually be read as a good thing. Let's see how the market reacts, but I'm going to take that somewhat contrarian approach to this reading and say, you know what, we know the bottom 3 quartiles of consumers are struggling. So this reading isn't particularly surprising, but what it suggests is maybe some of that excess demand runs off and that we have more concerns about the consumer, that maybe the Fed would lean into that. We'll see. What we can say about Fed funds futures is that the odds of a December rate cut are back on the rise again. So two-sided tape, we got our data. We also got pending home sales coming in at 76.3. Business inventories came in at actual of flat 0. So the biggest data point was consumer confidence. Going to give the market a little time to react to that. You can see liquidity coming back on the order books here. And we've evened out. It's now a supply and demand relatively balanced order book, 12 versus 13K, a delta of about 840, now 730 contracts between the two. So for me, again, to really put the bulls in favor of getting that slam dunk to the hot call, we want to see that flow continue to dominate. We want to see a push above the point of control. We want to see acceptance built there, and ideally this large delta, the 2754 around 6725, taken out to the upside. Then we'd probably have another, let's say 30, 35 points where the probabilities are very much in favor of the buyers for that sort of slam dunk magnet trade up to the hot call. We're not out of the woods yet, but that would be my setup. So I hope everyone enjoyed this week's episode of Back to the Futures with me, Markets and Mayhem. It pays to have restraint in a market like this. Tuesdays are often two-way trading days. If you want to get up to 40% off Traderade, visit wap.com/Traderade or Traderade.com. Use the code BlackFriday40. If you want to get a copy of Bookmap for yourself, visit Traderade.com/Bookmap. Scroll down to the special offers. Secure up to 40% off your first billing period. And as always, I'll see you next week, 9 a.m. Eastern, for the next episode of Back to the Futures with me, Markets and Mayhem. Have a great Thanksgiving if you're in the United States. And for everyone else, have a great week ahead. I'll catch you soon.